Hello everyone and welcome to the webinar, The Changing Futures Option Markets, Volume and Venues. We're broadcasting to you live from OptionsCity headquarters in Chicago, Illinois. I'm Pat Gardner with OptionsCity and I'm joined by Pat Carey from RCG and my colleague Bob Callie at OptionsCity. And the first thing we're going to do is actually have a brief guest speaker from RCG read a disclaimer for us.
Hi guys, thanks. Bear with me, I just have to read this really quickly. An investment in futures contracts involves a high degree of risk and is suitable only for persons who can assume the risk of loss in excess of their margin deposits. You should carefully consider whether futures trading is appropriate for you in light of your investment experience, trading objectives, financial resources, and other relevant circumstances. Past performance is not necessarily indicative of future results.
Thank you, Allie. And before I turn it over to Pat at RCG, I'll just give you a quick overview of some of the items we'll be covering today. Is option volumes exceeding pre-crisis levels of 2008 with growth expected to continue. Overall kind of exchange volumes based on product and asset class and the rate of growth in those product and asset classes and how trading is changing over these different product classes and what that entails in regards to regulation, global trading, and the specific needs of you, the trader. So now I'll go ahead and turn it over to Pat from RCG.
A little bit about Rosenthal Collins Group. We envision ourselves as a mid-tier FCM. Our focus is futures options. We do not participate in any Forex or any OTC products. We've been in the industry for a long time. We've got roots going back to the 1920s. We've got a wide range of clientele, everything from retail to professional traders to institutional hedgers. Because we've got such a wide range of clientele, we have a wide range of market access, primary focus, domestic markets, primarily CME Group, but we've also got reach into Europe and a little bit of Asia. We've also got a wide range of electronic trading systems. Obviously, we've got a good relationship with OptionsCity. Let's get into the presentation.
Thanks, Pat. So, as Pat Gardner mentioned, the intent of this discussion is to briefly talk about the different asset classes out there, their current market volume, growth trends, and the different venues that those asset classes trade in. I'm sure most everyone here can remember 2008, the financial crisis that occurred. Going into that year, volumes had continued their uptrend that had probably been present since the early 2000s. Obviously, when that happened, volumes took a nosedive and have struggled since then to get back to those pre-2008 levels. They've pretty much reached that this year and are expected to pass those 08 levels, which is, I think, exciting for everybody. So the first thing we're going to take a look at are the different asset classes and just kind of get an idea of where the volume is within those asset classes. So you can see on this slide, interest rate is obviously the highest volume traded asset class, followed by energy, equity, ags, FX, and metal. It's not surprising, I don't think from OptionsCity's point of view, that interest rate rules the volume space. Interest rate traders are definitely our largest clientele, actually followed by energy and equity probably. So that's not a surprise for us, and I don't know, Pat, do you see?
No, so over half CME Group's treasury options are trading on the screen. Bulk of those are going to be coming from either the euro-dollar markets or 10-year markets. One of the nice things there is around the clock access, right? So it's giving the global traders access into the CME and CBOT interest rate products on the screen. They're always coming out with new products, weekly treasuries. I know the exchange has been making a push to get liquidity there, and I think that's why you see the interest rate volume, just looks like it's doubling the energy there.
Yeah.
Yeah, I was Bob, the title of this slide is Volume by Asset Class. We kind of refer to asset classes as different product groupings here, and I think we use that consistently throughout the presentation, right?
I would agree with that.
I wanted to point this out. Some people like to divide up asset class between options, futures, stock.
Okay.
But we kind of mean asset class being product, a class for this situation. And is this volume in listed contracts traded?
Yes.
Is it option specific?
Yeah, option specific.
Okay. Thank you. I just wanted to clarify for everyone
No problem.
at home.
So that's what things look like from an asset class standpoint. The following slide will kind of give an indication on growth, and here you can see that equity has had the largest growth over the last 3 years, followed by energy, interest rate, FX, metal, and ags. I would say that, well, first of all, I'd say that the equity growth kind of surprises me. It's not where I hear a lot of people talking about trade occurring. I think a lot of this is a result of the introduction of weekly options, end of month options, that I think has brought a lot of the volume closer to expiration, if you will, or the short end of the options curve, and I think that's a big reason why you see equity growth. Although I don't necessarily think you're gonna see that growth continue in the equity options markets.
I think another reason you don't see equity growth per se is, as far as equity index options, if you talk about mini S&P, mini NASDAQ, it's on the screen. They don't have a ton of new products, although CME Group is coming out with some weekly and monthly mini Dow and $10 Dow options to try to get that growth. But seeing as though these products have been in the marketplace and on the screen for such a long time, I just, the equity growth rate, it's a bit surprising that that's the leader in growth rate.
Agreed, and I think energy actually has a good potential to continue its growth rate. In opposite of the equity, they're continually coming out with new products in that space, and there seems to be a lot of interest. That is a high growth area that we see at OptionsCity for sure.
I would agree. So natural gas has only got about 10% of its open interest and volumes on the screen today. Just over half of the crude oil options are on the screen. CME is making an effort with products that they've got, such as CME Direct, to educate the community about getting people access to the screen as well. So, if people we're currently using a call-around market via Clearport, they are out there educating the Clearport brokers that if they don't have enough volume to do a block trade, they can now put it on the screen and do a cross. So the CME is trying to move volume as well to the screen and get specifically in the energy market.
I know the one asset class here that surprises all of us is the growth rate in ags, and I kind of look at the ags market as the energy market 10 to 15 years ago. I think they are poised for a tremendous amount of growth. There are a lot of producers out there that are looking a lot more at the option space to hedge risk, and I think there's a lot of potential for growth in that particular market.
I would agree, and going back to what we talked about with the treasuries, it is a 24/6 marketplace now, so obviously people around the globe are trading the Board of Trade and CME agricultural products. I think part of the reason you don't see a large growth rate is almost all the cattle and hog options are almost already on the screen, so it's just if it's already almost all there, it's hard to grow it. But corn and beans, probably throw wheat in there too. I don't see why those wouldn't be growing, and it is surprising that ags is far back as it is, especially when you look at metals. In the metal complex, you only have a select group that you're looking at. You've got COMEX gold, silver, and copper. Copper does not have that much open interest in options. What is there is pretty much on the screen. So if the metals were going to grow, it would have to be in in the silver or gold market.
And I think that growth rate on metals is due a lot to the growth that we've seen over the last 3 years, and it's kind of tailed off since gold and silver have kind of leveled off price-wise. Pat, do you want to add something?
I was going to ask your guys' thoughts on the related to the ags. I know that in the energy space, a lot of the contracts that are traded, there's a lot of different ones, and there's various levels of extreme complexity to them. Maybe that's a result of them kind of being based in over-the-counter trades for kind of larger hedging purposes. But I know in the ags, the listed contracts, whether it's the short-dated stuff or the calendar spread options, are some newer, more complex, exchange-traded symbols. Do you think that the trend might be towards kind of more new, interesting type options contracts?
A lot of those products exist in the energy market to hedge daily risk. You're taking oil out of the ground, for example, every single day, and there's a need to hedge that risk, and is why a lot of those products were designed and are now traded. To be honest, I'm not that sure of what the requirements are for the ag world, but I don't think they are looking to hedge that finite a risk. So I think doing CSO options, doing regular monthly options are probably suitable for the risk they're trying to hedge.
Coincides with the seasonality of
Yeah.
the underlying commodity.
Yeah, more than trying to hedge a daily, type risk that you need to hedge when you're taking oil out of the ground every day.
Okay.
So, okay, so the next slide that we want to go over is where's the volume? Pit versus electronic versus off floor. And what's going on right now with respect to pit and electronic, it's reached about a 50-50 point. It's oscillated back and forth over the last couple years, and I think electronic is now kind of breaking through that 50-50 barrier, and will probably take more and more of the volume as time continues. I think the pit is still a place where large order consumers or traders need to, well, it's a good place for price discovery for large orders, and I think that is certainly a something that the pit gives the world that is difficult at this point anyway for the electronic screens.
I like the term price discovery, and I think that's why it is moving to the screen. So a couple years ago, you probably only had about 25% of options on the screen, right? If you go back to, we're talking about 2008, but 2008, 2009 probably only had about 25% of option volume on the screen. Now it is closer to 50-50. Obviously, some markets can be higher or lower. In the energy world, there's still a big call-around market, but again, CME is making a push to educate Clearport brokers about how they can put that on the screen, and it's providing transparency to the marketplace. But it's only going to move to the screen, right? So there are new exchanges. Eris is a newer exchange; they're only electronic. So these newer exchanges aren't going to build pits. Anything they list is going to be straight on the screen or a call-around market.
And there are a lot of products that the exchanges have introduced. User-defined spreads, or as many of you know them, RFQs are gaining a lot of traction on the exchanges. Those are the ability to submit spreads that users see and can quote or submit orders on. And I'll actually, for those of you who aren't familiar with these type of spreads, show you a quick slide. That's an OptionsCity RFQ viewer, and what you'll see there are different spreads that have been submitted by market participants like yourself, asking for a market on a particular spread that user of OptionsCity could either respond to with quoting or click trade, submit an order that's resting. This is the kind of stuff that's going to drive a lot more volume to the screens when the size and liquidity is there, and quite honestly, there's a lot more trading in these spreads now than have been in the past. If you look at some ES statistics, 60% of the electronic volume is done by spreads for the quarterly and serial options. So this is certainly the future with respect to how spreads are traded. And from a user standpoint, to get a market on one of these spreads, it's as easy as creating that spread. Well, within OptionsCity anyway, it's as easy as creating that spread. As you see here, there's a spread ticket for the 1840.95 call spread. The black circle is around an RFQ button. If I was the user and I wanted to RFQ that in the market to create a UDS, I simply click that button, it sends it to the exchange, and market participants can quote it or submit orders on it.
Yeah, so UDSs and RFQs are great for the end user. It gives them the ability to try to get that bid offer that they're looking for in the marketplace. A user-defined spread, if a user wants to try to figure out where a specific market might be, but it's not there, the exchanges give this ability to the end users to basically get a bid offer in that marketplace for them. If they don't like the quote that came back on the spread they built, they can try a very similar spread, again, put it out to the market, see what comes back. I think it's all about the transparency and bringing the marketplace together and creating those tighter spreads.
And the third venue that was mentioned on the previous slide was off-floor. Off-floor basically refers to places like Clearport or Ice Clear. Regulation is certainly forcing new products to be created and cleared via those exchange platforms. We've seen a large demand from customers, especially in the energy markets, to see block trades, which are now being disseminated by exchanges and viewable by customers. There's obviously a lot of information to gain from those large block trades that are occurring off floor, and that's another space that is now available to trade in and gain access to.
Yeah, I think it just goes back to more and more of these products are moving towards the screen, which makes it a bit easier for everybody to manage. And then as exchanges make the effort, it just becomes more transparent to the users and the general public, and again, just trying to tighten these markets.
So, the question that I think you have to ask yourself is, how is trading changing over different asset classes, and what new products are exchanges introducing to address regulation, global trading, and asset-specific needs? To go over a couple examples, in the treasury market, deliverable swap futures have been introduced to address regulation. In the ag space, short-dated new crop options have been introduced recently that reference the new crop month, but expire earlier than the traditional new crop options. Within the energy market, I think it's pretty clear that exchanges are trying to make sure their energy product offering covers a global energy market. And at the end of the day, I think traders need to make sure they're aware of all the different products that are within their asset class and the different venues that are available to trade them. As volumes continue to increase, where those volumes trade continue to define themselves, traders are going to require clearing firm relationships and software that gives them access to all these opportunities. And RCG, I think, is definitely a place that can help you with that, and we hope that OptionsCity is as well. Anything to finish up with?
No, we can go into any questions that anyone has right now. Go ahead and type into the GoToWebinar pane and let us know any questions you might have. I don't see any in there yet, so I wanted to ask the two of you a question, Pat and Bob. There's a lot of talk about the Chinese marketplace and them, their exchanges, existing futures contracts, eventually, it's soon to be options contracts. I think they're been delayed a few times. Especially in the agricultural world where they are a large producer. Is that going to affect how do you think that might or could? All speculation, I suppose. Trading here.
Well, I would say that we Board of Trade, CME Group, agricultural products are kind of the benchmark in the world, right? For corn, beans, wheat, and yes, there are some contracts around the world that with some larger open interest. I think TOCOM has like the red beans that has just enormous open interest, but the world really does come to CME Group to do a lot of the hedging on agricultural products. So I only envision that growing, but anybody will be coming to do the interest rate options in the near term, because I think that's the next real place for growth as the Fed continues to talk about increased rates. I think the interest rate options are really the next thing that could really boom.
Yeah, I mean, my comment on that is volume begets volume, and if other global exchanges open and start producing more open interest and volume, I don't think that necessarily takes away from other venues, but could add liquidity to those venues as people try to hedge themselves in a global manner. So,
sure. Well, traders here traditionally in Chicago had to be more aware of this and maybe even adjust what was previously, before any electronic trading, a very kind of short window of a short work day on the floor. Is that going to continue to kind of expand?
Yeah. I mean, I think people are definitely doing that already. I mean, we have our fair share of users who are starting to look to trade, especially in the interest rate complex, starting to look at trading the European versions of whatever they're doing in the US. So I definitely think that proprietary traders who are experts or subject matter experts in a certain asset class are looking to expand that expertise into different exchanges across the world.
Okay. We do have a question. Someone asks if ultimately, migration towards electronic trading is likely to result in tighter bid-ask spreads.
Go ahead. You want to answer?
Yeah, I mean, I think that goes back to the UDSs and transparency that, the exchanges making the ability for end users to create their own spreads on the fly, and just trying to quote more spreads out there. I do think the electronic trading has provided the transparency, probably increased some liquidity. You may argue that, but I think it's certainly tightened the markets.
Yeah, I mean, I would agree with that. I think they do historically tighten markets. The $50 million question with that is always, well, how much liquidity is really there on those tight markets? And that goes back to my comment about the pits, where the pits are still relevant for price discovery for large volume orders. An ES market can be 500 up, and you go to sell 200, and you only get 50 because the market's really not 500 up. It's moving high frequency fast and moving around. But I think on average the markets do tighten, and will get more liquid. So yes, I would agree with that.
Someone had an interesting question point on here about the volatilities being at a historical low, and saying that lends to more electronic screen trading, and that volatility increasing could move some of the volume back into the trading pits.
Yes and no. It can certainly go to the pits. It can certainly stay on the screen. I think the next place for volatility is probably going to be interest rate area, when the Fed continues to talk about what they're going to do there, and it's just going to lead to uncertainty and volatility there.
Yeah, I mean that's an interesting thought. I could see that happening. I mean, well, what I will say is, as volatility increases, markets tend to widen back out. So if the reason why you're trading on the screen is because the markets are tighter, and vol increases to the point where the screen doesn't know really where it should be, yet the pit does, then I could certainly see that. But I mean, vol would have to really increase, I think, to cross that threshold where electronic markets get wider than what you get in the pit.
Okay, great. I'm going to check and see if there's any more new questions on here. I don't see any right now. Do either of you have anything you'd like to ask your co-presenters at the moment? Okay, well, I'll let everyone know that, and thank you for joining us. Let you know that we will have a link available to a recording of this webinar, and we can probably get you the presentation in slide format as well. If you're interested, feel free to contact RCG or OptionsCity as need be as well. And thanks again for joining us today, everyone.